Right now, on TikTok, there are teenagers filming themselves bragging about their Afterpay limit, like it's a credit score they earned through hard work. Just got approved for $2,000 on Klarna, they say, smiling, while in the same breath posting about being stressed over rent. And somewhere between those two facts is the entire story I'm about to tell you. Because here's a statistic that should stop you mid-scroll. People using Buy Now, Pay Later are between 17 and 26% more likely to make a purchase they otherwise wouldn't, and they spend roughly 30% more on stuff they don't need than if they were just paying cash. 30% more on stuff that doesn't matter. That's not a financing option. That's a behavioral hack, and it's been deployed on a population that, by every metric, can least afford to be hacked. Let's talk about financing a burrito. Let's talk about putting a Costco hot dog on a 4-installment payment plan. I'm not joking. This is a real thing happening in the real economy. And the fact that it sounds absurd to you is exactly why it works. Klarna, Afterpay, Affirm, they've spent the better part of a decade marketing themselves as the smooth, friction-free, almost invisible way to buy things. No interest, they say. 4 easy payments, they say. It feels like nothing. And that's the entire point, because debt that feels like nothing behaves very differently than debt that feels like something. While this was happening in the background, completely unregulated and largely unmeasured, Buy Now, Pay Later ballooned into something like a $700 billion pile of consumer debt that doesn't show up on a single credit report or get counted in a single government debt statistic. $500 billion, $750 billion, take your pick. The number keeps moving because nobody's actually required to report it properly. So today, we're going to rip the friction back into this frictionless experience. Time to learn how money works. Let's start with the trick at the center of this entire business model, because it's almost impressively cynical once you see it. Buy Now, Pay Later companies do not call themselves lenders. They call themselves something else, a deferred payment provider, a point-of-sale facilitator. Language specifically engineered by lawyers to dodge the legal definition of a loan. And why does that matter? Because if you're legally a lender, you're regulated like one. You have to check whether someone can actually repay you. You have to disclose terms the way credit cards are forced to. You're subject to a century of consumer protection law that exists precisely because unregulated short-term credit has destroyed households before. But if you're not technically a lender, almost none of that applies to you. So Klarna can approve someone for a 4-payment plan on a pair of sneakers in about 4 seconds. No hard credit check, no real verification of income, no real assessment of whether this person is currently drowning in 5 other Buy Now, Pay Later plans from 5 other apps, because nothing connects them. This is the loophole the entire industry is built on top of. It's not a side effect, it's the business plan. And here's the part that should make you laugh if it didn't make you furious. When people predictably can't pay back loans that were extended without checking if they could pay them back, the industry's reaction is something close to genuine shock. It's the financial equivalent of the shocked Pikachu meme. You handed out credit to people with no underwriting standards whatsoever, and then acted stunned when a chunk of it didn't come back. That's not bad luck. That's the business model working exactly as designed, just not in the direction they wanted. And it gets messy, because a real percentage of users are now doing something researchers have started calling loan stacking, which is just financial gymnastics with a polite name. They take out a Buy Now, Pay Later plan, and when the payment's due and they don't have the cash, they put it on a credit card instead. So now what was marketed as an interest-free, debt-free alternative to credit cards is just quietly transformed into credit card debt anyway, except now it's stacked on top of 3 or 4 other invisible Buy Now, Pay Later balances that no bank, no credit bureau, and frankly no regulator can see all at once. You are watching consumer debt evolve specifically to avoid detection in real time. Now let's talk about the part of this that hits you even if you've never once used Klarna in your life, because this is the part nobody explains. And it's the most quietly enraging fact in this entire video. Buy Now, Pay Later companies charge merchants a transaction fee, the same basic concept as a credit card swipe fee, except theirs is dramatically higher. Visa and MasterCard typically take somewhere around 2 to 3% per transaction. Buy Now, Pay Later platforms can charge merchants up to 8%, 8% for the privilege of letting a customer split a purchase into 4 payments. Now here's where it gets interesting, because merchants can't just turn around and charge buy now, pay later users a special surcharge to cover that fee. The platforms explicitly forbid that in their merchant agreements. So a retailer eats an 8% cost on every single buy now, pay later transaction. And a business doesn't just eat a cost like that out of generosity. It has exactly one place to put it: the price tag. Yours, mine, everyone's. The customer paying in cash, the customer paying with a debit card, the customer who has never even heard of Klarna. All of them are quietly subsidizing the 8% fee generated by somebody else's for-payment plan on a hoodie. This is the invisible tax nobody voted for and nobody can opt out of, baked directly into retail pricing across the entire economy. And it gets worse if you're a small business, because the merchants getting hit with that full 8% are disproportionately small and mid-sized retailers who have basically no negotiating leverage. Meanwhile, the giants, the Walmarts, the DoorDashes, the massive retail platforms moving billions of dollars in volume, those companies negotiate what are effectively sweetheart deals, paying a fraction of that fee, because buy now, pay later platforms desperately need their volume and their brand legitimacy. So the math shakes out almost perfectly backwards. The small shop down the street pays the highest fee, has the thinnest margin to absorb it, and has to raise prices the most as a percentage just to survive, while a trillion-dollar retailer pays next to nothing and barely notices. The little guy and the everyday consumer are left holding the bag so that a logo can sit next to the checkout button. So with all that money flowing in from merchant fees, you'd assume buy now, pay later companies are an absolute goldmine, right? This is where the story takes a turn that genuinely surprised me, and it's the part that makes this entire industry, in my opinion, one of the great unforced errors in modern finance. Credit cards as an industry are spectacularly profitable for banks. Interest payments, late fees, annual fees. It's one of the most reliable profit engines in the entire financial system, generating tens of billions of dollars a year in pure margin. Buy now, pay later companies looked at that machine, decided they could build a better, friendlier, more frictionless version of it, and have proceeded to lose staggering amounts of money trying. Affirm has posted hundreds of millions of dollars in net losses across multiple fiscal years. Klarna, despite years of claiming a turn toward profitability, has swung between brief profitable quarters and enormous reported losses, including losses stretching into the hundreds of millions in some periods. These are not small accounting hiccups. These are structural losses built into how the business operates. And the reason is almost poetic if you think about it. The entire customer base buy now, pay later was built to serve is, by definition, the population traditional lenders consider too risky to extend credit to cheaply. That's the whole pitch. We say yes when the bank says no. But the bank says no for a reason. That reason is called credit risk. And when you say yes anyway to millions of higher-risk borrowers with no real underwriting, your default rates climb in a way that simple math cannot ignore. You can't out-engineer credit risk with a slicker checkout button. So you end up with this almost beautiful paradox sitting at the center of the entire industry. They build a business specifically to be predatory toward financially vulnerable people. And they are, by virtually every financial metric available, currently terrible at it. They're not profiting off the poor. They're subsidizing the poor with venture capital and shareholder money and calling it disruption. So if it's losing money and it's quietly taxing the entire retail economy, why does it keep growing? Because of where it's expanding into next. And this is the part of the story that stopped feeling funny to me. Buy now, pay later started, very explicitly, in the world of treat yourself. Fashion, sneakers, a flashy gadget, the kind of discretionary splurge you didn't strictly need but wanted, the kind of purchase you could justify breaking into for payments because, hey, it's fun money. That was the original pitch, lighthearted, low stakes, almost playful. That is very much not where the growth is happening anymore. DoorDash now lets you finance a delivery order through Klarna. Multiple major grocery delivery platforms now offer buy now, pay later directly at checkout. People are splitting grocery bills, fast food orders, basic household necessities into 4 payments, not because they want to treat themselves, but because the sticker price of groceries and a quick meal has climbed faster than a huge chunk of paychecks ever did. Call it the muck recession, if you want a label for it. A quiet, rolling downturn where the visible economic indicators look fine on a spreadsheet in Washington, but a measurable slice of working people can no longer comfortably absorb the cost of dinner without financing it. When the product being split into 4 payments shifts from a designer handbag to a bag of groceries. That's not a story about consumer convenience anymore. That's a story about wages quietly losing a race against the cost of staying alive. And remember that shadow debt figure from earlier, the $700 billion or so sitting completely outside official tracking. Put it next to the roughly $1 trillion in formally reported, regulator-visible credit card debt in this country. We're talking about a second, nearly invisible debt economy that has grown to a size equal to a meaningful fraction of the entire visible one. Except almost nobody studying the health of the American consumer can actually see it, because by design, it was never built to be seen. So where does this actually go? I think the honest answer is the same place every venture capital-funded frictionless platform eventually goes. And there's a term for it now that's entered the popular vocabulary: shittification. The pattern is depressingly consistent. Phase 1, flood the market with an experience that feels almost too good: free shipping, no fees, instant approval, funded by investor cash that's betting on future market dominance, not present-day profit. Phase 2, once users and merchants are sufficiently locked in, once buy now pay later is wired into the checkout flow of half the retail internet, slowly start tightening the screws. Raise merchant fees further. Introduce late fees that didn't exist before. Start charging consumers directly for things that used to be free: processing charges, subscription tiers, premium pay-in for access. The free, frictionless version was never the destination. It was the bait. Companies losing hundreds of millions of dollars a year do not get to stay generous forever. Not when they eventually have to answer to public shareholders demanding an actual path to profit instead of an actual mountain of growth metrics. The cost has to land somewhere. It always does. The only open question is whether it lands on the merchants through higher fees, on you through higher prices and new charges, or on the next group of buyers who get told yes by an app that should have said no. Here's your hard-to-swallow pill. Since you've made it this far, roughly $700 billion of debt is currently sitting outside any system designed to track it. A meaningful percentage of buyers are already stacking that debt on top of credit cards just to keep current, and the companies running the entire show are losing money doing it. That is not a sustainable arrangement. That is a countdown. The golden age of frictionless debt is ending. Not because regulators are finally stepping in, but because the math underneath it never worked in the first place. Don't forget to like and subscribe.